Let me paint you a picture. You've sold your UK property. The completion statement is signed, the money is in your account, and you're feeling rather pleased with yourself. You treat yourself to a nice dinner, maybe a decent bottle of something. And then approximately 3 weeks later, you receive a letter, and I use that term loosely because it's more of a demand from HMRC. At which point, the nice dinner feels like a very distant memory. The thing is, with a little forward planning, that letter either doesn't arrive at all or it contains a number considerably smaller than you feared. That's what this video is about. Welcome back to the Expat Accountant. I'm Ad, a UK qualified accountant and British expat living in France. Over the last 3 videos, we've covered UK tax residency, French tax residency, and what happens to your UK pension in France. Today, we're tackling UK property, specifically capital gains tax when you sell UK property as a French resident. This is one of the most searched topics amongst British expats and also one of the most misunderstood. Quick disclaimer, this is general information only, not personal advice. Right, let's get into it. Let's start with the fundamental question. Do you still pay UK capital gains tax on UK property when you're a French resident? Yes, you do. I know some of you were hoping the answer might be no, but it isn't. The UK taxes capital gains on UK residential property regardless of where the seller lives. This was tightened up significantly in 2015 and again in 2019. So if you've read anything older than that online, please disregard it. The rules have changed considerably. Under current UK rules, if you sell a UK residential property and make a profit, you are subject to UK capital gains tax on that gain. Your status as a non-resident does not exempt you. In fact, there's a specific regime called the Non-Resident Capital Gains Tax, or NRCGT, that exists precisely to capture the gains made by people who've left the UK. HMRC thought of everything. How very thorough of them. The current UK CGT rates on residential property are 18% for basic rate taxpayers and 24% for higher rate taxpayers. These rates apply to the gain or the profit, not the total sale price. And you must report the sale to HMRC within 60 days of completion, not 60 working days, 60 calendar days. Miss that deadline and there are automatic penalties regardless of whether any tax is actually due. This catches people out constantly, including people who really should know better. Right, so how is the gain actually calculated? This is where things get interesting, in the way that accountants find things interesting, which admittedly isn't everyone's idea of a good time. The basic calculation is simple enough. Sales price minus purchase price equals gain. But there are several things you can deduct to reduce that gain legitimately, and many people don't claim everything they're entitled to. So purchase costs. Stamp duty, land tax paid when you bought the property is deductible. Legal fees on purchase are deductible. Survey costs are deductible. Improvement costs. Money spent genuinely improving the property, an extension, a loft conversion is deductible. Maintenance and repairs are not. This distinction matters and HMRC is quite particular about it. Replacing a broken boiler is maintenance, not deductible. Adding a second bathroom is improvement, deductible. When in doubt, keep every receipt. When not in doubt, also keep every receipt. Selling costs. Estate agent fees, legal fees on sale and costs of any required surveys or reports are all deductible. Annual exempt amount. Every UK taxpayer gets an annual CGT exempt amount. the amount of gain you can make before tax kicks in. I won't quote the current figure in this video as it's been changed several times in recent budgets. Check the HMRC guidance for the up-to-date number. But it applies to non-residents selling UK property too, so make sure you're claiming it. The rebasing date. This is crucial for anyone who bought their property before April 2015. HMRC only taxes gains accrued from April 2015 onwards for non-residents, not the entire gain since purchase. If you bought your UK property in 2005 for say £200,000 and it was worth £350,000 in April 2015, only the gain from £350,000 upwards is potentially taxable, not from your original £200,000 purchase price. For properties that have been owned a long time, this can make a very significant difference to your tax bill. Getting a professional valuation as at April 2015 is therefore well worth doing before you sell. Now, here's the part that can potentially reduce your UK CGT bill very significantly, and it's called Principal Private Residence Relief, or PPR, because we do love an acronym. PPR is a relief that exempts the gain made during periods when the property was your main home. If you lived in the property as your main residence for part of your ownership period, the proportion of the gain relating to those years is exempt from CGT. So if you owned a property for 20 years, lived in it as your main home for 15 of those years, and then rented it out for 5 years before selling, roughly 75% of your gain would be exempt under PPR. The remaining 25% relating to the rental period would potentially be taxable. There's also an automatic final period exemption. Currently, the last 9 months of ownership always qualify for PPR relief, even if you weren't living there, as long as you have lived there at some point. This was previously 36 months and was reduced, so again, check current HMRC guidance, as these things do change with each budget, usually in the direction of the less generous in my experience. The combination of PPR relief and the rebasing date can dramatically reduce a CGT bill that initially looks alarming. This is why getting proper advice before you sell, not after, is so important. There may be planning opportunities that simply aren't available once the sale has completed. One thing worth noting for expats specifically, to qualify for PPR, you must have actually lived in the property as your main home. You can't retrospectively claim it was your main residence if you've been renting it out the entire time you owned it. HMRC is not known for its generosity in interpreting these rules, and they do check. Right, so we've established that UK will tax your gain. So what does France want? As a French tax resident, you are required to declare your worldwide capital gains on your French tax return, including gains on UK property. Yes, France wants to know about it too. France is nothing if not thorough. However, and this is the important bit, the UK-France double tax treaty allocates the right to tax gains on immovable property, that's land and buildings, to the country where the property is located. So for UK property, the UK gets primary taxing rights. France will require you to declare the gain, but you'll receive a credit in France so that you don't pay tax twice. In theory, this prevents you paying full CGT in both countries. In practice, the calculation of the French credit and how it interacts with the French tax on capital gains, which has its own rates and social charges on top, can be complex. The French tax treatment of UK property gains is one of those areas where the theory of the double tax treaty and the practical reality of filing in both countries diverges somewhat. Get professional advice. One thing France does not do, incidentally, is apply the UK's rebasing date. France calculates the gain from the original purchase price. so your French and UK calculations of the gain may produce different numbers, which is entirely normal and not a cause for alarm, merely a cause for careful paperwork. Now let me run through the practical reporting requirements, because this is where people come unstuck. UK reporting. Since April 2020, UK residential property disposals must be reported to HMRC, and any tax due must be paid within 60 days of completion. You do this through HMRC's online CGT on UK property service, separate from self-assessment. Even if you think no tax is due, perhaps because PPR covers the entire gain, you may still need to report. Check the current rules on gov.uk or take advice. You will also need to include the disposal on your UK self-assessment tax return for the relevant tax year, even if you've already reported it through the 60-day return. Yes, you report it twice. HMRC has its reasons, I'm sure they're excellent. French reporting. The gain goes on your annual French tax return in the year the sale completes. Your French tax advisor can help ensure the credit mechanism is applied correctly so you're not overpaying in France. Record keeping. Keep absolutely everything. Purchase documents, completion statements, receipts for every improvement ever made, correspondence with estate agents, legal completion statements. CGT calculations on properties held for many years can require documents going back decades. A shoebox is not an adequate filing system, but it's better than nothing. A well-organised folder, physical or digital, is really your best bet. So let's bring this together. As a French resident selling UK property, you will face UK capital gains tax on any gain made since April 2015. Your gain can be reduced by purchase costs, improvement costs, selling costs, PPR relief if you have lived there, and the annual exempt amount. You must report to HMRC within 60 days of completion, no exceptions. And France will also want to know about it, though the double tax treaty should prevent you paying full tax in both countries. The key messages are these. Get advice before you sell, not after. Understand your PPR position. Get a professional evaluation as at April 2015 if you've owned the property since before then. And keep all your paperwork. Done properly, UK property CGT as a French resident is entirely manageable. Done without planning, it can be an expensive and stressful surprise. Much like buying a property in France without a survey, something else I'd strongly recommend against, but that's a story for another day. Next week, I'm covering something that affects almost every British expat in France, the French income tax return. What it is, how it works, what you need to declare, and how to actually file it without losing the will to live. Subscribe so you don't miss it, leave your questions below, and I'll see you next Thursday.